Welcome to the Daily Update. This is Being Prepared Friday, June 24th, where we'll look at the action in the market today and then see how things look for Monday, June 27th. It was a pretty positive day. The scenario that we've been working with, that maybe there's a rotation going from value back over to growth, that seems to be holding up and it seems to be continuing. And with that, we're seeing prices continue to improve. Now, we just want to know, can it continue? Now, it's probably not going to continue in a straight line, even if this is the scenario that's unfolding. There will be some down days. It won't just go straight up. But at the same time, we want to keep an eye on what's happening in the different sectors. And if we're going back over into growth, then that bodes well for the market and for the indexes to go higher. So let's go back and talk about what happened on Friday. The futures were quite strong, and at the open, we had a gap higher above R1 at 38.18, and we even went up to R2 at 38.40. In fact, I had to break out the old pivot calculator to calculate R3, and you'll see that on the chart. As the day went on, we just drifted sideways. There wasn't a lot of additional buying that came in, but more importantly, there wasn't a lot of selling that came in. We just drifted. And then going into the close, there was some more late day buying, which might have been some short covering, because you've got a lot of people who are just convinced that the market is going to go down and that what we're seeing right now is a dead cat bounce. And that may be true, but after the gains that we saw and the lack of selling that we saw on Friday, a lot of the people in short positions, they had to get out, especially before a weekend. And they might have been seeing some significant losses. So remember, they have to buy to get out, and that could have pushed prices up a little bit more. We ended up going above R3 at 38.99. Now, how is that? 3,900 for another resistance level. We were battling with 3,800. Now we're dealing with 3,900. We were up 3.06% on above average volume. It was a Friday, and typically we'll see a bit more volume on those days, but not always. The technicals, they're still negative, but showing a lot of improvement. And I have a lot of charts to show you where I'll back that up. Inflation and interest rates are still the big concern, which are flowing through to growth concerns, geopolitical concerns, and we potentially might even have a domestic concern. The Supreme Court came out with some rulings this past week that some people may not like, and there might be some violence. Whether that's going to impact the markets or not, I don't know. We had a lot of things going on back in 2020, and it didn't seem to have that big of an impact on the stock market itself. So we'll just have to see how that goes. Earnings reports as they are released, and then we're still battling back and forth. Are we going into a recession or are we not? So some comments that we can make is the market may be bottoming here. We've had a couple of bounces. We've had some confirmation from some other charts that usually suggest that we might be going higher from here. It's not always a sure thing by any means, but the market may be putting in a bottom. The 10 to the 5 yield curve is still inverted. It's the only one. Fear is negative, but with the advances that we've seen, we're no longer extreme negative. We did regain the 10-period moving averages. Haven't seen those in a long time. And we even got back up to the 20-period exponential moving average. We had some economic reports that showed that new home sales increased by 10.7%, where we had been seeing some declines, maybe with interest rates really going up, maybe with some problems in the economy. People are rushing out to do what they need to do sooner rather than later. And so we might be seeing a pickup in home sales. And this was on a seasonally adjusted annual rate of 696,000 units. That's about 100,000 more than what they expected. But when you look at it on a year over year basis, sales were down 5.9%. Final consumer sentiment also came in at 50. The last reading we had was at 50.2. That's what they expected, but it came in even a little bit lower than that. So people are just not happy. But there's a little bit of a lag time with this. This is a week or so ago, and people are seeing a lot of their 401ks, their retirements, their Roth IRAs, all that stuff They're seeing a lot of the gains go away and they're not feeling as good about things. And that's when this survey was taken. So maybe it will improve if the market does in fact start to go up. And I'm going to have to cough. Sorry about the lack of editing abilities. Our trend is still negative, but it's weakening. With the up days that we've seen, we're seeing the ADX start to come down. I've switched the bias back over to positive because we've had a couple of good days now. And the momentum is also going more to mixed. Not quite convinced yet. If we have one more good solid up day, then I'll probably change the momentum to positive. So you could say mixed with a potentially positive slant to it. Let's go back and look at sentiment. We came up out of the extreme fear category. Now we're just fearful overall. And here's the historic chart to show how we've been coming up out of that. This shows that capitulation has really come from the bond market, not necessarily in stocks. This blue line is flows, and this just shows money going out of bonds, where this darker blue line is a 4-week moving average of the flows going into or out of bonds. So the bond market has really been getting hit, but it's been very oversold. It potentially could be bouncing off some support. If that is true, and if things hang together enough, we could see bond prices go up, which would bring interest rates down. The global equity outflow over the last 9 weeks, it's also negative now, but the 4-week moving average is still positive overall. That's the dark blue line right here. But here's the latest report with the lighter blue line. This is kind of an interesting chart. It just shows where the current bear market sell-off has been more severe than average. And this goes back to the 16th of June. Here's where we are now, this orange line, this is the current price. And these are other times when bad things have happened since 1950. And we'll have to see, are we going to be able to bounce up out of that like this darker blue line? That's what happened when we did not have a recession. If we did have a recession, we follow this lighter blue line and things still stayed pretty difficult after that. The jury's still out on what's going to happen right there. We're getting some conflicting information that I'll show you in a second. Another thing is these cyclicals and the earnings that are attached to these cyclicals. These are more the defensive value plays. They're kind of concerned, are we getting a little ahead of ourselves? This blue line is the general trend of what it should be. And this orange line up here is pretty far away. And so they may be coming down with some of their earnings estimates. Or right now anyway, if they don't come down, they're still pretty extended or pretty positive. And here's the same chart again. Not sure why I wanted to show that. Okay, what's going on here? There. So this just shows the median forward EPS drawdowns. What happens? So when we have a recession, we typically see about a 15% drawdown or contraction in the forward earnings per share. That's what we have over here on the right side. I'm sorry, over on the left side. If we don't have a recession. If we do have a recession, it's a lot more severe. And we're not really sure right now what's going to happen with all of that. We had the NAAIM number come out, and these are the active asset managers. And this was from a week ago when we were really headed down severely. So it's probably not surprising that they're pretty extreme negative right now, which possibly could be adding some support to the market because it's so far extreme. The buybacks by corporate clients, it's starting to come down a little bit. They've been buying back a lot of stock, which should help to elevate their price levels, but we've been seeing a little bit of that decline lately. This is the size of S&P 500 10% or more corrections since World War II. And this just shows the non-recession median right in here is at about 12.5%, where this orange line, I know this is a little hard to see, this is where we're at currently at the time this chart was created. This is what usually happens when we do have a recession. So even if we go into a recession, we're kind of getting close, or we were close. We've been bouncing up lately, but we're kind of getting close to, I'm sorry, the current is right here, this blue line. We're pretty close to having had a recession. So in this context, you might even be able to say they've already priced in a recession. I don't know. With the contradiction that we're seeing in the different reports right now, I wouldn't necessarily buy into that so much. If it does come out that we are going into a recession, we probably will see some trouble. If the GDP comes out and other things come out that show that the economy's hanging in there, if not actually growing, then that might tend to help this bounce that we've been seeing. And maybe it will lead to something more than just a dead cat bounce. The Fed funds rate here is at the bottom, and it's been going up. And the earnings growth rate, it just shows that as the Fed raises interest rates, earnings, the growth rate anyway, has a tendency to come down. Doesn't mean that they're negative earnings. It just means they grow slower because now companies are having to pay more in interest. And so that hurts their bottom line. So they still might be positive, just slowing. This came from Tom Bowley in his daily email, or I think he does it 3 times a week. He went back and looked at all the bear markets going way back into about the 1950s or so. And he called them a cyclical or secular bear market. Basically, the idea is a secular bull market goes on, bull or bear market goes on for a long, long time, years, where a cyclical is usually shorter in duration. And so what he did on this spreadsheet is he looked at all the different cyclical bear markets that we've had going back to, I think the first years, since 1950. And the average drawdown during that time was 27.38%. We got down to about 23, 24% on an intraday level with the S&P 500. But what's interesting after this is once you hit that bottom, 6 months later, here are the returns. A year later, here are the returns. And 5 years later, 10 years later, blah, 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 blah. Down at the bottom, he kind of summed it up. He said, the S&P 500 1 year later, as of June 17th, it would be at 4713 if we go with the worst of these averages. This 1 year average return, that's 29.59%. We would be at 5186 if we go to the average 1 year return, 42.49%. And we get all the way up to 6489 if we go up 78.41%, which was the best return according to this study that he did. Take this for what you want. There are other people that really rely heavily on this, and they're more money managers or risk managers. And so they have to kind of look at things this way. Sometimes this can be beneficial, but just to nefariously go out and say, hey, a year later, the average is this. I understand that, and I like that, and I think it's interesting, but I don't base my decision-making processes on that. But that's how I do it. You might do it differently. The latest reading for the National Financial Conditions Index shows that even though this is climbing, we're still below the black line. The St. Louis Financial Stress Index is showing that we're really going down right now. So there's, according to this, there's not an awful lot of stress on the banking system, which if things go totally crazy, it means they should be able to handle that, or they're handling any problems that are going on right now. The spread between the risky loans and non-risky loans, it's continuing to go up over here on the right side, but it's not necessarily spiking. The economic policy uncertainty is showing that we're really decreasing in the latest reading. And here's another GDP nowcast. This is different than the GDP real GDP now, whatever that other thing is. But this is put out by the St. Louis Fed, where the other one's put out by the Atlanta Fed. You'd think they'd email each other or something, but nah. This one's actually showing that they think that GDP will be at 3.87%. right now. So that's part of the confliction that we're seeing, where the last GDP Now reading was at 0, wasn't positive or negative. This one has us quite a bit more positive. We also had the individual investors weekly survey come out, and they are extreme negative. The VIX is declining as we are bouncing up a bit here, both on a line basis, and we're dropping below the moving average on both of these charts, the bar chart and the line chart. The VIX of the VIX also continues to drop overall. The Ulcer Index is starting to roll over a bit, but it's still pretty high, showing that there's still a lot of fear. We're now out of bear market territory for what that's worth. We're down 18.82% from the all-time high. Equity put call ratio declined on a 1-day basis and on a 5-day basis, has also been declining. Here's this chart from Byrd, thinking that we are right about here where I'm circling my pointer, suggesting that we're at the late part of this decline that we've been in. We might be at the early part of a recession, and this is typically where stocks will bottom out, because stocks tend to be a leading indicator, not a following indicator. We also had the final release of the consumer sentiment. It declined all the way down to 50. It had been at 50.2. Now it's at 50. So there's really a long spread between, or a large spread between the 2-year and how people are feeling right now. And the Ridex bear bull ratio, it dropped a little bit to 0.11. That seems to update. When I got these years ago, they would update on a daily basis. These are just kind of sometimes yes, sometimes no. And here's the AAII breakdown. It just shows how many people are bullish, 18.2, how many are bearish, 59.3. And here's their little speedometer chart too, showing that we're still kind of tipping over towards the negative section. But again, they flip-flop what I would do on this. Support and resistance, here are the levels for Monday's session. And here's the daily chart showing that we were able to break back above this pivot level. That's pretty positive. We were able to get back above the previous low set in May. That's also positive. And we're now right at the pivot point. Isn't that interesting how those things tend to stop at that point? This is just the machine gun chart showing how we're trying to break above this pivot level now. If we continue to go up, we now have some more support underneath where we're at if we start to decline. And here's the same chart, just trying to take some of that mess off of there. I don't know if that helps or not. We were able to get back above this fib level, which kind of acted a bit as resistance. Well, we broke above that. So this will probably be the last time you see this chart unless we really start to change. Also, with the pivot levels for the whole month of June, they remain the same. We just update it with a bar each day. And the fib retracement showing how we broke down below this fib level, but now have been able to come back above that. Also breaking above. And the interesting thing about this fib level is that there are 2 of them on top of each other. So to me, that adds extra redundancy here, that when we break through one of these levels, it tends to mean more. And here's the weekly chart showing that we were able to break back above this level that had been acting as support. So that could be positive too. And here's where we show that same fib retracement of 50% with the 200-week moving average just about in the same place. Double line of support there. Our sectors, and I'm going to have a second chart right after this. This just shows that materials were up the strongest, communication, discretionary, a lot of the growth areas are starting to see some advancing, where utilities, healthcare, energy, they were up, but not as much. So if the rotation is happening, we'll start to see the tech, communication, discretionary, we'll start to see those go into the lead, and the other ones that are more value-based, like even the materials to a degree, because some of these go back and forth, but the financial sector, healthcare, Staples is kind of the big one to watch. If they start to lack their leadership role, that could really help with the scenario that maybe we're rotating more into growth. And here's the second chart. And I sorted this according to a thing called Scooter. This is a stock charts proprietary thing where they take a bunch of technical indicators and feed them in and come up with a score. And the higher the score, the better the stock is performing on a technical analysis basis. And even though it's had some recent weakness, energy has been doing the best, and staples and utilities. And these are the ones that have been performing pretty well. We want to watch, are these numbers going to start to decline? The areas that have been the weakest, tech, discretionary, and communication, they're not as strong, but after watching this chart for a few days, they are showing some improvement. Their scores going up. And this just shows that energy still is in the lead where all of the other sectors are not. A lot of technical alerts. I'll just go into the S&P 500 ones. We got back above 3,500. And we had a BPI cross above 30. I'll show you that. And we were able to get briefly above 3,900 on there. So we had all positive signals. The futures were looking pretty positive. And I wanted to include more than what I have here just because I missed the video on Friday, but I just wasn't able to do that. But we were up. Europe was doing pretty good. And then this bar right here was the open. Now, looking at the day chart shows how we did gap higher above R1. We even got above R2. This is when I broke out the calculator and put this line on here, only to see us finally get to R3, which is something that doesn't happen very often, as we went into the close. And if I said we got above 3,900 briefly, I was mistaken by that. Our trend just shows where the selling pressure is coming down, the buying pressure is increasing, so the ADX is starting to roll over. If you're more aggressive, then you've already taken this cross as meaning that maybe the trend is changing, or maybe we're going into no trend, where if the red line and the green line do cross, then we'll want to see the ADX start to turn back up and go higher. That would support the idea that we're in an uptrend. Or if we start to decline from here, this could really begin to go back up as well, because that's what it's already picking up, is the downtrend. The Arun shows a bit of a decrease in selling, bit of a decrease in buying, so we're flat overall. Looking at breadth, we kind of overdid it on a one-day basis with the advanced decline ratio. The advanced decline line is showing some improvement based on price and volume. Our AD ratio is also turning back positive. New highs, new lows are still negative, but starting to show some improvement. Right here, it just shows the 10-day average of the highs and lows, which is the same as this green line right here. We're camped out at a pretty extreme negative reading, but we are bouncing up a little bit from where we were. Accumulation distribution. We were able to get back above the moving average. And if we can stay above it, then the moving average, the red line, will start to turn up. Short term, we might have overdone it on a rate of change. Looking back at the 5 periods, also may have overdone it. Here's a moving average chart. Haven't seen them in a long time. We were able to close back above the 20-period exponential moving average. It moves quicker. We haven't been able to get back to the simple moving average yet. And here's our moving average tree thing that I haven't shown in seems like forever. But we've been so far away from these, there hasn't been any reason to look at them. Here's our rainbow. Haven't seen one of these in a while, where we're trying to go back up into the short-term rainbow. This is based on 10, 20, 30, 40, 50. Then I have an intermediate term and a long-term rainbow, but we have to get through the short-term one if we have a chance at the longer-term rainbows. The force index went positive, and we're actually up near the top of the Keltner band up here. So we might have overdone it a little bit. We're still showing positive advances on price and volume with the Swinland trading oscillator. McClellan oscillator has also turned positive. We're turning up with our 20, 50, and 200 period moving averages. Stochastics, positive short term, positive intermediate term, and slightly positive with the longer term. Intermediate charts, PMO is not crossed over yet, but is looking better. We want to keep an eye on the price and volume. They sometimes cross first. The PMOs that are rising is starting to get extreme positive, but showing a lot of improvement here. The buy signals are turning up, and we're trying to ever so slightly turn up with those PMOs above zero. Standard deviation, as we go back up, since we came down so fast, that's what the standard deviation was picking up. And now that we're coming back up, this is starting to come back down to the blue line here. Chaikin oscillator continues to be positive. Chaikin money flow, it's kind of bouncing around, but has a green bar there, so it's positive. Volume picked up a little bit because of Friday's pretty healthy volume, and I have to clear my throat. The boom indicator is coming off of an extreme negative reading compared to the 50-period moving average, and we're bouncing up with the 200. Vortex, seeing a decrease in selling, increase in buying. Summation index, turning up based on price and volume. Some of our momentum oscillators, like the MACD, it's getting ready to cross over positive, and the TSI is getting ready, where we have slope, and the PMO is showing a lot of improvement. Some of our longer term ones, like the KST and the TRIX, they're turning a little bit, but have not crossed over, at least yet. The BPI, this is when we went back above 30 after giving a pretty extreme negative reading. Rate of change going back 50 periods shows that we are still extreme negative. Money flow index is advancing. The ease of movement is also advancing, but still below zero. And I haven't shown this, the triple exponential moving average, that's the blue line here. It's a little hard to see. And then the double exponential moving average, that's the green line here. What I really wanted to point out is that we were able to get back above this anchored moving average from the 2020 low, the COVID low that we set. TTM squeeze, it shaded this out a little bit, so it's not a dark red, so that could be more positive. Our different charts, the Heiken Ashi is showing a lot of improvement. The Kegi has switched back to positive. The point and figure added 2 new X's, and we have a signal called a low pole reversal. So that's positive right now. Renko redrew, and now we have an open box. That's more positive. 3-line break also is looking much more positive. So we're seeing a lot of technical improvement here. The Elder for the S&P is back to positive. It's green, as is the SPY. This is still negative. The SAR, the dots still remain on top. So that hasn't switched yet. And we've gone more to the pale purple as far as the go, no-go system. Long-term charts, we're bouncing up from the 50, 150, and 200 moving averages. Rate of change, we're bouncing up after giving a pretty extreme negative reading. So that's just showing some improvement. And here's the 250, which goes back even longer. And then here's a longer term look at that same chart. Special K continues to decline. The diamonds are back to positive, as are the Qs. And then I didn't show the VIXN for a few days because of this crazy line right here. I thought it was erroneous data that they would get rid of. Well, it is erroneous data, but they haven't gotten rid of it. So I wanted to just show how the VIXN has been declining on the bar chart, and we're showing a decline with the lines as well. The stocks in the S&P were bouncing up after having most of them below their 50-period simple moving average. Mid caps are also bouncing, and the small caps continue to bounce. The CRB got hit pretty hard, but we're still in an overall uptrend overall. Copper it bounced up a little bit on Friday, but it's really starting to drop. We want to keep an eye on that. That's kind of a economic thermometer gauge that is often used. The dollar was down a little bit. It's still hanging around about the 103, 104 level. The S&P to the dollar ratio just shows that we're almost back to neutral as far as what kind of relationship do they have right now. Oil was up to 107.62, and the correlation is almost back to neutral as well. Gold hasn't really been doing much of anything. The ETF's now below the 200-day moving average. Here's the longer term chart. Silver also has been having some trouble, even though it was up 0.72. it gapped lower, so it had a lot that it had to try to make up on here. And here's the silver ETF. Looking at bonds, a little bit of a decrease with corporate bond prices, bit of a decrease with all of the bonds in the ETF. The PRING, and this is what I'm talking about with this index. We're coming down and we're not at, but we came close to the COVID low. If we could see a bounce up out of this, that might help interest rates to come down. And the S&P to the 10-year, just showing that they still have a pretty strong inverse relationship, but it's starting to get, it's wearing off a bit. The tech to the 10 is also wearing off after having been strongly inversely related. We only have one yield curve chart that's negative, and that's the 10 to the 5. We're coming back down after this had been support. We broke through that. Now, if we do start to go back up, this may act as resistance on the 10-year yield. Here's also the 10-year yield shown you in a little different way. This shows how interest rates went up, but not astronomically on Friday. And here internationally shows it for the week. US rates came down, as did UK and German rates. Japanese rates are still hovering around about as low as they can go right now. Intermarket analysis just shows that oil is still up overall, even though we've seen some real weakness lately. The dollar has been hanging in there. Gold is just barely positive since the beginning of the year. Stocks are starting to turn up where bonds are still having some problems. Possible positive scenarios. We're still working off of this idea that once this spiked, the 5-period moving average of the equity put call ratio, that sometimes provides a good bottom for the markets. And it's been climbing as the market has been climbing. We're also coming off almost an extreme negative reading with those stocks that are above their 200-day moving average, the percent of stocks. And this is the same indicator, just actually it's a different indicator measuring the same thing. And this is what we're kind of latching onto right now. We're seeing the negative divergence with a lower price in the S&P. We're still seeing the Q ratio go up, the discretionary ratio go up, and the growth ratio go up. And here is the large cap, mid cap, and small caps. These ratios continue to advance. It's kind of the opposite of what we saw at the end of 2021. Here's our channel. So far, we are bouncing off of this dashed line. The spike, well, it spiked up a little bit more and then came back down. So we don't really know if that's a legitimate spike or not. The correlation between the S&P and the 2-year, it's starting to get back more neutral again. And the small caps, they're really underperforming right now with the S&P. So we're not really getting a reading on this chart. The staples have been doing pretty good, but not as good. So even though they spiked up a little bit, we are still below this high spike that we made. But again, we want to see more follow through of price. So what's our outlook for Monday? The technicals are improving and we have some possible positive setups. Sentiment is not as extreme as it was. It's still negative, but not as much as it was. We have durable goods orders coming out on Monday. We have all the geopolitical events, Russia, Ukraine, China, supply chain issues, the inflation and interest rates, margin calls if we continue to fall. Oil is always in the back of everyone's mind. Earnings, maybe not as much Fed speak now that that's over with, but they might give an interview or there might be a speech somewhere. We're still keeping an eye on things in Japan. People are still debating about a recession. And then this domestic unrest that I mentioned at the beginning with these Supreme Court rulings, it might get ugly, but I don't know if that'll affect the markets or not. So what are our scenarios? We're still negative overall with all the things that I just talked about, but the technicals are starting to turn positive. So this scenario is not looking as viable right now. How can we go up? Because the technicals are improving, there's a disbelief that the market is not going to go up. And we have these possible positive setups and the possible positive scenarios, which may be suggesting that we're seeing sector rotation. Our technicals are showing some improvement, but we're just getting back to some shorter moving averages. So we want to look at the pivots, the fib retracements, previous levels to provide either support or resistance. We're kind of maybe headed towards neutral if we really chop sideways for a while, but right now we're not neutral, but we are in a weakening trend. So our conclusion is the S&P is negative, but possibly rotating back to growth, and it's also showing improvement. That's overall. Short term, negative and improving. Intermediate term, negative but improving. Long term, we are still negative. So thank you. Have a wonderful weekend. I will prepare the weekly video and the intermarket analysis video and post those as soon as possible.